Welcome to the wealth continuum. The largest asset manager in the world doesn't make desperate moves. BlackRock controls over $10 trillion in assets. They don't chase trends. They don't panic. They don't follow retail investors into risky bets. So when Larry Fink, the man who built this empire, spent years calling Bitcoin a tool for criminals, and then suddenly launched the most successful ETF in Wall Street history, something fundamental had shifted. And whatever forced BlackRock's hand is the same force quietly rewriting the rules of money itself. January 10th, 2024. The SEC approved 11 spot Bitcoin ETFs all at once. Within 48 hours, BlackRock's iShares Bitcoin Trust pulled in over $1 billion. That's not normal. ETFs usually take years to build momentum. The first gold ETF took 3 years to reach $1 billion in assets. But Bitcoin? Institutional money flooded in like water through a cracked dam. By the end of the first month, BlackRock's IBIT had accumulated over $2.5 billion. By March, it crossed $10 billion. This wasn't just success. This was a statement. And here's what nobody's talking about. BlackRock didn't want to be first. They wanted to be inevitable. Because by the time they filed in June 2023, they had already seen what was coming. They saw the cracks in a system they helped build. If you're watching this right now, you are ahead of 99% of people who still think Bitcoin is just some internet money for tech bros. This channel exists to connect the dots between macro policy, hidden financial shifts, and the strategies institutions don't want you to understand until it's too late. So do me a favor, hit that subscribe button right now. Because what I'm about to walk you through isn't just about Bitcoin. It's about why the old system is eating itself and why the smartest money in the world is quietly preparing for what comes next. And drop a comment telling me where you're watching from, whether you're in Texas or Tokyo or somewhere in between. I want to know who's paying attention. Let's rewind. 2017. Larry Fink calls Bitcoin an index of money laundering. Bitcoin was trading around $4,000 back then, heading toward its first major peak of nearly $20,000 in December of that year. Fink dismissed it entirely. 2020. He says it's a speculative asset with no real use. Bitcoin had just crashed from $10,000 to $3,800 during the March COVID panic. Because BlackRock doesn't sell products. They sell access to the future of capital flows. And they saw the future, and it didn't include them unless they moved fast. The financial system BlackRock dominates is built on a few key pillars: U.S. Treasury bonds, the petrodollar, central bank coordination, infinite liquidity from the Federal Reserve. For 40 years, that system worked flawlessly. You print dollars, export inflation, buy assets, repeat. But something broke after 2008, and it shattered completely in 2020 when the Fed printed $5 trillion in 18 months. Suddenly, the rules stopped making sense. Inflation came roaring back, not as some distant threat, but as a real erosion of purchasing power. By June 2022, CPI hit 9.1%, the highest in over 40 years. The Fed raised rates faster than any time in modern history. From March 2022 to July 2023, they hiked rates from 0.25% to 5.5%. That's 22 rate hikes in 16 months. Bonds got crushed. Banks started failing. March 2023, Silicon Valley Bank, Signature, First Republic. These weren't small regional players. SVB alone managed over $200 billion in assets. And they collapsed because the very thing that was supposed to be safe, U.S. Treasury bonds, became toxic when rates spiked. If you're a bank and you bought 10-year bonds at 1% in 2021 and now rates are 5% in 2023, you're sitting on massive unrealized losses. You're insolvent on paper. That's not a conspiracy theory. That's FDIC data. And here's the kicker. The Fed can't fix this without breaking something else. If they cut rates to save the banks, inflation rips higher. If they keep rates high to kill inflation, more banks die and the economy craters. They're trapped. And BlackRock knows it, so they started looking for an exit ramp, not out of the system entirely, but into something parallel, something that doesn't rely on the Fed's printing press or the Treasury's credibility, something scarce. Bitcoin has a hard cap, 21 million coins, ever. No central bank can change that. No politician can vote to inflate it. No emergency printing. It's the opposite of every monetary tool used since 1971 when Nixon closed the gold window. And that's exactly why institutions ignored it for so long. Bitcoin was a threat to the system they controlled, but now the system is threatening itself. And BlackRock had to make a choice. Ignore the fastest growing alternative asset and lose relevance, or control the on-ramp and dominate the next phase. Here's what most people miss. The ETF wasn't about making Bitcoin legitimate. Bitcoin was already legitimate. By 2023, daily trading volumes regularly exceeded $20 billion. Entire nations adopted it as legal tender. El Salvador in September 2021, Central African Republic in April 2022. The ETF was about control. When you buy Bitcoin directly, you own it. You control the keys. You don't need BlackRock or any institution. But when you buy the ETF, you're buying exposure through a regulated wrapper. BlackRock holds the Bitcoin. You hold a claim, it's the same game they've played with gold for decades. The GLD ETF, launched in 2004, holds physical gold, but most investors never see it. They just see a number on a screen. And that's fine for them, but it means BlackRock stays in the middle. They capture fees. A 0.25% annual fee might sound small, but on billions of dollars, that's tens of millions in revenue every single year. They maintain influence. They turn a decentralized asset into another product they can package and sell to the masses. And the masses showed up. By the end of 2024, BlackRock's Bitcoin ETF had pulled in over $30 billion. It became one of the most successful ETF launches ever, surpassing the milestone achievements of products that took decades to build. Pension funds started allocating. State pension systems like Wisconsin Investment Board disclosed Bitcoin ETF holdings. But here's the deeper layer. Why now? Why not 2017 during the first big Bitcoin run to $20,000? Why not 2021 at the peak of $69,000? Because the macro environment wasn't ready. Back then, the Fed was still pretending they had control. Inflation was transitory, they said. The bond market was stable. 10-year Treasury yields were below 2%. There was no urgency. But by 2023, the cracks were undeniable. The Fed had lost credibility. After calling inflation transitory for months in 2021, they were proven catastrophically wrong. Inflation stayed sticky above 3%, even as they jacked up rates. The banking system needed secret bailout facilities just to stay afloat. The BTFP, Bank Term Funding Program, was created overnight on March 12, 2023, to stop contagion. The Fed opened a $25 billion emergency lending facility, which eventually grew to nearly $165 billion. That's not strength, that's desperation. And globally, things were shifting even faster. BRICS nations started talking openly about alternatives to the dollar. At the August 2023 BRICS summit in Johannesburg, discussions about a common currency intensified. Saudi Arabia let the petrodollar agreement expire in June 2024 after 50 years. That deal, signed in 1974, was the foundation of dollar dominance. Oil priced in dollars meant the world needed dollars. It meant endless demand for U.S. debt. It meant America could run deficits forever without consequences. But now the Saudis are accepting yuan for oil transactions with China. Russia and China settled over $200 billion in trade using their own currencies in 2023 alone. The world is slowly, quietly, methodically moving away from dollar dependence. BlackRock sees this. They have analysts in every major capital. They manage money for sovereign wealth funds that know exactly what's coming. They have access to data retail investors will never see. And they understand that if the dollar loses its reserve status, even partially, the entire architecture of American finance shifts. Bonds become less attractive. Stocks become more volatile. Real assets, scarce assets, become the only safe harbor. And Bitcoin, for all its volatility, is the scarcest asset ever created. Gold bugs love to argue that gold is the real safe haven. And they're not wrong. Gold has 5,000 years of history. Central banks still hoard it. Global central bank gold purchases hit a record 136 tons in 2022. But gold has problems. It's hard to move. Transporting $100 million in gold requires armored trucks and massive insurance. It's expensive to store. Secure vault storage costs 0.5% to 1% annually. It's controlled by a few major players. Just 5 countries hold over 50% of official gold reserves, and it's not growing. Annual gold production adds roughly 1.5% to 2% to total supply each year. Bitcoin's issuance rate is currently around 1.7% and drops by half every 4 years during the halving events. The next halving in April 2024 cut new Bitcoin issuance to just 3.125 coins per block, or about 450 Bitcoin per day. That's approximately $30 million in new supply daily at current prices, compared to the billions flowing into the ETFs. Bitcoin, on the other hand, is digital. It's borderless. You can move $1 billion in Bitcoin across the globe in minutes for a few dollars in fees. It's accessible to anyone with internet. It's programmable. Smart contracts and layer 2 solutions are being built on top of it. It's transparent. Every transaction is recorded on a public ledger that can't be altered. And it's still early enough that the upside is exponential if adoption continues. When BlackRock filed for their ETF, Bitcoin's market cap was around $500 billion. Gold's market cap is roughly $13 trillion. If Bitcoin captures just 10% of gold's market share as a store of value, that implies a Bitcoin price well over $130,000 per coin. BlackRock didn't launch this ETF because they love Bitcoin. They launched it because they had no choice. The financial system they have mastered for decades is entering a phase of instability that can't be solved with the old playbooks. You can't print your way out of a debt crisis when inflation is already running hot. You can't raise rates forever without breaking the economy. The U.S. national debt hit $34 trillion in early 2024, with annual interest payments exceeding $1 trillion for the first time in history. You can't keep the dollar dominant when the rest of the world is actively building alternatives. So you diversify, you hedge, you move into assets that aren't tied to any single government's decisions. And here's where it gets really interesting. The ETF is just phase one. Phase two is integration. Right now, most of the Bitcoin held by BlackRock's ETF just sits in cold storage with custodian Coinbase. It's not being used. It's not generating yield. It's just there as a store of value. But Bitcoin's infrastructure is evolving. Layer 2 solutions like the Lightning Network processed over $200 million in monthly transaction volume by late 2023. DeFi protocols are being built on Bitcoin sidechains. Institutional custody is getting more sophisticated with players like Fidelity Digital Assets and Anchorage handling billions. Within a few years, it's entirely possible that BlackRock and others start offering Bitcoin-backed lending, Bitcoin-denominated bonds, or other financial products that treat Bitcoin not as a speculative asset, but as a foundational layer of the financial stack. Imagine a world where your 401k holds Bitcoin the same way it holds bonds, where corporations keep 5% of treasury reserves in Bitcoin to protect against currency debasement, the way MicroStrategy started doing in August 2020, accumulating over 150,000 Bitcoin by 2024, where central banks quietly start accumulating Bitcoin as part of their reserve mix, the way some smaller nations are already considering. That's not science fiction. That's the logical endpoint of the trend we're already seeing. And BlackRock is positioning itself to be the intermediary for all of it. But let's talk about the risks, because nothing is guaranteed. Bitcoin is still volatile. It crashed from $69,000 to $15,500 between November 2021 and November 2022. That's a 77% drawdown. Regulatory uncertainty is real. Governments could crack down. China banned Bitcoin mining and trading in 2021. India waffles between bans and regulations. The US could decide that Bitcoin threatens the dollar too directly and impose harsh restrictions. That's possible. But here's the counterpoint. The more institutions hold Bitcoin, the harder it becomes to ban. When pension funds, endowments, and sovereign wealth funds have billions in exposure, a ban becomes a political nightmare. You're not just hurting crypto bros. You're hurting teachers' retirement funds in Wisconsin. You're hurting university endowments at Harvard and Yale. You're hurting your own donor class. And enforcement is nearly impossible. Bitcoin doesn't care about borders. It doesn't require banks. It exists on a decentralized network of over 17,000 nodes spread across the planet as of 2024. You can ban exchanges? Sure. You can make it hard to convert to dollars, but you can't kill the network. And as long as the network exists, Bitcoin has value. The network has maintained 99.98% uptime since its launch on January 3rd, 2009. No bank, no government system, no tech company can claim that kind of reliability over 15 years. This is why BlackRock moved when they did. They saw the window. They saw that Bitcoin had survived every previous crisis. Met Gox in 2014 when 850,000 Bitcoin were stolen. Let's zoom out even further. What we're witnessing isn't just about one ETF or one asset. It's about a transition. For over a century, the global financial system has been built on fiat currencies backed by nothing but government promises. That worked as long as governments were disciplined. But discipline is gone. The U.S. national debt is over $34 trillion. Debt to GDP is well over 120%. Deficits are structural, not cyclical. The 2023 deficit alone was nearly $1.7 trillion. Entitlement spending is locked in, with Social Security and Medicare consuming over $2 trillion annually. Defense spending isn't getting cut, sitting at over $800 billion. Interest on the debt alone is now over $1 trillion a year. That's more than the entire defense budget. How do you pay for that? You print. But printing debases the currency. Since 2020, M2 money supply increased by over 40%, the fastest expansion since the data began in 1959. It punishes savers. A savings account earning 0.5% loses value when inflation runs at 4%. It creates asset bubbles. The S&P 500 increased over 100% from March 2020 to December 2021. It widens inequality because those closest to the money printer, the banks, the institutions, the ultra-wealthy, get the new money first and buy assets before prices rise. The top 1% saw their wealth increase by $10 trillion during the pandemic. Everyone else gets the inflation. This isn't sustainable. And deep down, everyone knows it. That's why gold hit all-time highs above $2,100 per ounce in December 2023. That's why real estate stays elevated despite mortgage rates above 7%. That's why Bitcoin, despite all the crashes and chaos, keeps coming back stronger. People are searching for something that holds value outside the system. And BlackRock, the ultimate insider, is now offering that to the masses through a regulated, accessible product. It's brilliant, it's cynical, and it's necessary. Here's the question you should be asking. If BlackRock sees Bitcoin as essential, what does that tell you about the future they're preparing for? They don't make moves based on hope. They make moves based on data, trends, and inevitability. They have access to the smartest economists, the best models, the deepest insights into central bank policy. Larry Fink meets with Fed chairs and Treasury secretaries. BlackRock's Aladdin risk management system processes over $21 trillion in assets. And their conclusion was clear. Bitcoin isn't going away, it's going mainstream. And they needed to be the bridge. Now think about what happens next. Right now, Bitcoin's market cap is around 900 billion. Gold is over 13 trillion. Global real estate is worth over 300 trillion. The bond market is over 130 trillion. If Bitcoin captures even a small fraction of those flows as a legitimate alternative store of value, we're talking about prices that seem absurd today, but could be conservative tomorrow. A 5% allocation shift from gold to Bitcoin would push Bitcoin's price to over $200,000. A 1% shift from bonds would add another $100,000. BlackRock doesn't need Bitcoin to go to $1 million to win. They just need it to keep growing, because they earn fees on every dollar that flows through their ETF. The bigger Bitcoin gets, the bigger their revenue. At $30 billion in assets and a 0.25% fee, that's $75 million annually. If they reach $100 billion, that's $250 million per year, forever. But for you, the individual, the implications are different. You're not BlackRock. You don't get paid just for facilitating flows. You either position yourself early or you watch from the sidelines. And positioning doesn't mean gambling your life savings. It means understanding that the rules of money are changing. It means recognizing that the institutions that laughed at Bitcoin 5 years ago are now building their entire next generation product lines around it. The irony is thick. Bitcoin was designed to eliminate the need for trusted intermediaries. Satoshi Nakamoto's white paper from October the 31st, 2008, explicitly described a peer-to-peer electronic cash system. It was supposed to be censorship resistant, beyond the reach of institutions like BlackRock. And yet, here we are. BlackRock is now the biggest gateway to Bitcoin for traditional investors. They've co-opted the revolution and packaged it into the same system Bitcoin was meant to replace. Some will see that as defeat. Others will see it as inevitable. The truth is, probably somewhere in between. Bitcoin, the network, is still decentralized. Over 17,000 nodes, no single point of failure. Bitcoin, the asset, is being institutionalized. Over 900,000 Bitcoin now sit in ETFs. Both can be true. And maybe that's the only way this ever works at scale. Maybe mass adoption requires the old guard to adapt rather than collapse. Maybe BlackRock launching an ETF is a sign that the revolution won, just not in the way the purists imagined. Because the revolution wasn't about destroying institutions. It was about offering an alternative. And now, for the first time in modern history, people have a real choice. They can stay in the traditional system, holding dollars and bonds and hoping central banks don't destroy their value. Or they can diversify into something scarce, something global, something that doesn't depend on any single country's fiscal or monetary policy. BlackRock didn't give people that choice out of kindness. They gave it because the alternative was losing relevance in a world that's moving on without them. And that's the signal. When the biggest players start hedging the system they built, it's time to pay attention. When a company that literally advises the Federal Reserve on monetary policy decides to offer Bitcoin exposure, that tells you everything about where they think this is headed. So where does this leave us? The Bitcoin ETF isn't the end of the story. It's the beginning of a new chapter, a chapter where digital scarcity becomes a legitimate asset class, where central bank policies drive people toward alternatives, where the line between traditional finance and crypto blurs until it disappears. BlackRock will keep launching products. Other institutions will follow. Fidelity, Invesco, VanEck, all launched Bitcoin ETFs on the same day. Regulators will create frameworks. Governments will try to control it. And through all of that, Bitcoin will keep running. Block after block, every 10 minutes, transaction after transaction, immutable, unstoppable. Over 820,000 blocks processed since January 3rd, 2009. The real question isn't whether BlackRock had a choice. They didn't. The system forced their hand. The real question is whether you see what they see. Because if the largest asset manager in the world is betting that Bitcoin is the future, and they're willing to stake their reputation on it after years of skepticism, then maybe, just maybe, the future is already here. It's just unevenly distributed. And the gap between those who understand what's happening and those who do not is about to become the wealth gap of the next decade. So I'll leave you with this. What does it mean when the institutions that control the old system start building the bridge to the new one? Does it validate the new system, or does it capture it? And more importantly, what are you going to do with that information? Think about it. Drop your thoughts in the comments. Tell me if you think BlackRock launching this ETF was a sign of Bitcoin's victory or its compromise. because that debate matters. It shapes how we move forward. And if you made it this far, you're exactly the kind of person who needs to be part of that conversation. Don't just watch the wealth continuum unfold. Understand it. Position yourself within it. And never stop questioning who benefits when the rules change. I'll see you in the next one.